Welcome to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank that brings you market views and insights on the go.
Hello everyone, my name's Manpreet and welcome to Cut to the Chase. Now in US equity markets, it almost feels like more of the same. US markets had another volatile day, as did many Asian markets, with Korean, Japanese and Hong Kong markets leading the move lower. From our point of view though, I think three additional observations are interesting here. First is that the selling, to state the obvious, remains concentrated in equity markets alone, particularly the tech sector. We find it interesting that high-yield bond markets, commodities and the US dollar have been relatively stable, especially in the most recent part of this sell-off. Now, in our view, this supports the view that the sell-off is a repricing of likely Fed policy rather than a broader risk asset sell-off. Now, European equities, of course, offered an interesting example of this divergence. We saw financials actually display pretty strong gains. We know they do benefit from higher yields, while the technology sector, which sees higher yields as a headwind, did suffer. Now, this naturally begets the question of whether it's time to buy the dip. It's something we'll be discussing in a little more detail on Friday. But to add one more perspective, one report I came across today showed that high-frequency funds seem to have almost entirely unwound their equity positioning, but long-term investors and retail investors seem to have already started buying the dip. Now, timing precise bottoms is always very difficult, but we believe tonight's Fed meeting will be key to setting the tone from here. Now, a Fed confirmation that the market's current pricing of Fed policy is appropriate, for example, could help bring some calm to equity markets and the technology sector. So as a reminder, that's due at 2 p.m. Eastern US time or around 2 a.m. Singapore time. Now, the Fed, of course, being the key event over the next 24 hours, but two other things we thought were worth discussing today. In Singapore, the Monetary Authority did surprise markets by tightening policy intra-meeting. Recall, in Singapore, that means raising the rate of appreciation of the effective exchange rate currency basket. It's another signal of how policymakers feel the need to respond to elevated inflation amid strong growth, with Singapore being a particularly good barometer of global trends, given the importance of international trade to its economy. Now, this offered more support for the Singapore dollar, but as we've discussed here before, we believe it's the commodity currencies like the Aussie or the Loonie, which may offer more direct exposure to that recovery in global growth and tightening central banks. The Australian dollar, interestingly, staying above key support around 71 cents to the dollar after stronger than expected inflation. And finally, some of you might know that El Salvador has been one of the few countries to recognize Bitcoin as legal tender, with the country's president regularly buying the dip in the cryptocurrency with public funds, and reports say he even plans a $1 billion volcano-powered Bitcoin city. However, this is complicating financing negotiations with the IMF, which says the use of Bitcoin places risks on financial stability and fiscal liabilities. So will a cryptocurrency rebound prove the president right, or will his hand eventually be forced by the need for funding in more traditional currencies? Drop me a note on LinkedIn if you have a strong view on which view will eventually play out. So we'll leave it there and we'll be back tomorrow with more on the Fed specifically. But if you enjoyed this podcast, please don't forget to rate and like it. Thanks for listening and we wish you a happy trading day ahead.
Thank you for listening to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank. For more details on the latest market insights, subscribe to Standard Chartered Money Insights.